A sea of red for the financials after bank analyst Michael Mayo warned that the loan losses will probably exceed levels seen in the Great Depression era. Mayo, who left Deutsche Bank for CLSA, started coverage on U.S. banks with an underweight rating today. Joining me now with her perspective on financials is Meredith Whitney, founder and CEO of Meredith Whitney Advisory Group. Nice to have you on the program, Meredith. And of course, you were really the first to come out here a long time ago and talk negatively about the financials. Do you agree with Mayo's report today that we are going to see loan losses worsen?
I think that's out there, right? We know that charge-offs are going to go up dramatically. There's nothing that would cause anyone to believe that they would improve in any way. So that's really out there. And I think even when the market was so oversold, people understood that this would be still continuing to be worse throughout the year. I think what's interesting is, and what I think people should be really careful of is, numbers could be horrible and earnings could be horrible, and goodness knows, losses are going to be higher, but tangible ratios could actually be better. And so I think you've got to avoid really putting on a lot of shorts here until the companies report, because you could have companies that barely make money and the tangible book values actually go up. So what I thought was, and I'm not bullish by any measure on financials, but I think you've got to be very careful pressing shorts here.
Well, this is a little slight change to the positive, isn't it, Meredith?
Well, it's a short-term change to the positive, right? Like, all bets are off and all rules are subject to change when you bring the government in. And the government was, it was the week of hope and change last week in terms of G20, and there was so much harmony in terms of, love, peace, and financials, to the extent that they agreed on FASB. FASB will remove a liquidity discount that's embedded in a lot of the valuations for financials. So arguably, those valuations will go higher. There are issues in terms of agreement on different government participation plans, government regulation. It's the fact that everyone agreed was a sentiment play, but the reality is that tangible book values, which is everyone's focusing on, are going to go higher. Now, people will say, okay, even other analysts may say, okay, this stock is worth 80% of book. But if book values are rising, so too will the stock prices, and that's my only point. I mean, I don't think we get out of the woods in terms of a fundamental, from a fundamental standpoint, through mid-2010. But that doesn't mean you can't have 90-degree angle trading opportunities in this market, and you got to be really careful.
Well, we just had a trading opportunity for the banks on the upside. All this money having moved into financials. You're saying lay off on the shorts right now, but would you be committing some capital to these banks on the buy side over the near term for trade?
I think what's going to happen is you had a very oversold market, so the market rallied, and then you had real reasons to be even more scared of being short on financials for these fundamental reasons, valuations, and also a lot of the banks got sort of backdoor financing from the federal government by this massive agency trade, where they increased their holdings of government-backed securities, government-sponsored agency securities, Fannie, Freddie, Ginnie Mae, and made billions of dollars off of writing those securities up. So this quarter is going to look stronger, and as a result, if these financials look stronger, perhaps private money comes in and supports them on additional capital raises.
Yeah, it's a really good point that you make. I want to ask you about that because Tony Crescenzi from Miller Tabak sent me an email earlier. He says that the term asset-backed securities loan facility, the TALF, will be opened for the second time tomorrow, and the results will be closely watched for signs of thawing in the securitization market. What do you think happens then when that TALF is opened again for the second time?
Well, here's another issue. I don't know that the TALF has to be fabulously successful, but the fact is that the TALF can have some type of trading activity. Remember when Morgan Stanley merged with Citigroup's investment advisor, Smith Barney? You could have had a penny transact, but it set the valuation higher. So Citi was able to write the value of their Smith Barney up by $6.5 billion. TALF could cross securities at levels the market hasn't seen in many, many months. And as a result, more tailwind for the banks to be able to write these assets up. So the illiquid assets will stay illiquid. The marginally liquid assets may get some type of deck chair movement, and the banks will feel better. And it's a perception game here. It's a mental stimulus, psychological stimulus move the government's doing here.
As far as the toxic assets, what's the incentive for a big investor to say, okay, yeah, I want to be buying these assets right here with the expectation that in fact they are going to be going up in value? I mean, the pricing is very difficult. to figure out here? Because obviously the banks want to sell them at as high as
Right.
possible. The government wants to buy them as low as possible. But what's an incentive for an investor if I wanted to buy into that?
Well, if you're an investor and you think you know where house prices are going to bottom, and you know that there's a government backstop, there's government funding for these securities, then you might throw your hat in there. I mean, I believe that home prices on a peak to trough basis are going to be 66% worse than the banks are carrying these assets. So they'd have to be really, really cheap. So, more than, 30 plus worse than the futures market. I mean, things are going to get really bad here. So if you've got, real, steel type,
you can sleep at night,
you can sleep. Sure. Yeah, I don't know that you could sleep at night buying these securities, but they're making a go at it.
Well, that's the point I was trying to make, actually. And as far as the housing prices, you wrote in the most recent report that housing prices are not done falling just yet. How severe is it going to be? Look, we got some good news on existing home sales. We got some good news on new home sales. Is that, should I not read into it?
I think that this is a couple months, and this will be inclusive of first quarter results. The head fake of all head fakes. And my new estimate is that peak to trough home prices go down 50%. Now, people thought I was off my rocker last year when I said 40%. Consensus is at 40% now. So you've got a ways to go. Now, liquidity is still coming out of the market dramatically. So there are fewer buyers for the same inventory. And, banks can say they're lending all they want, but net loans are going down. And that's across the board. So the consumer's really squeezed here.
All right, so here we are about to hear about the first quarter from corporate America. What are you expecting in terms of earnings in the financial services sector? Obviously, losses are going to be the name of the game, right, in terms of the first quarter?
You'll see a directional turn that the banks will, by and large, make a little bit of money, and this will be the first quarter in unison where they actually show profits. Now that means banks could make a penny a share, but they won't lose money because of these markups. Now this is most of the banks. We know that they were
profitable January and February, most of them.
Right, pre-marks, and they all said pre-provision. The provision is what kills them here because there are trillions of dollars of loans that they underwrote with bad math, so they've got to keep catching up on the provision basis. But let's say they have all of these different mechanisms through which they can not lose money. But then below the line, there's something called the OCI line. They're able to write up valuations. Investors may say, and may react the way they did Friday with the unemployment number, say, you know what, the worst is over. And to the other analyst's point, credit quality is getting worse. Yeah, well, that lags, and unemployment lags. And there'll be a lot of, so what, I'm going to be the smarter investor and get in. And I think that smarter investor is going to cost that same smarter investor a lot of money because after the stress test results come out, I think you're going to see some decent-sized banks have alternative situations. That's a nice way of saying not pass the stress test. You'll have other banks that will put a lot of assets up for sale. And so this is, I'm just saying, be careful towards the end of the month. And the end of the month is when the stress test comes out. And that'll be another grim time for financials. So
how effective or impactful will the FASB changes on mark-to-market be in this quarter and this year?
Well, it works out this way. So the FAS change is required to be effective in June 15th. But if you have all of your ducks in a row, you can accelerate that change retroactively to March 15th. So I think some of the more technology-savvy companies I would expect a JP Morgan, a Bank of America to be in a position to say, okay, we're going to adopt these changes early. So they'll get the advantage of writing these securities up and having more flexibility. Writing the securities up because the liquidity discount is removed. I would not expect Citi to be in a position to be able to adopt this early. They'll probably adopt it in June. I don't know, but I think some of the companies, you've got to have your very intensive cash flow modeling to say what these securities would be worth just on a cash flow basis as opposed to what the market deems they're worth.
You said you want to lay off some shorts over the near term. Would you actually put money into any one bank? Who's best positioned right here?
I think you've got, a name that I think about that was so hurt by the mark-to-market accounting and the auction rate securities was State Street. For the same reasons that a lot of these stocks went down, they go up. You look at companies that have big OCI lines in terms of
So you like
underlying.
State Street?
Yeah, I think that's if they're going to benefit from markups. Any of the trust banks, I think that which would be Northern Trust, State Street, Bank of New York. Bank of New York will be an interesting one on the positive side. I'm so chicken because I'm fundamentally so bearish about the core liquidity fundamentals that for me to go out on a long would be I'm not ready for that.
Right.
But there are some financials that scare me more than others.
As far as the liquidity, when would you expect capital markets to start improving? We've had a really nice run up, 25% or so in the S&P 500 in the last 6 weeks.
Yeah.
Would you buy into that? Do you think that the capital markets are beginning to show some stability or any reason to get invested?
Not at all. I think that the capital markets had a really good January and February because there was so much pent-up demand. Businesses have to roll their debt, and you saw some thawing in the capital markets. Capital markets are always some multiple of global GDP, and global GDP is still shrinking. So the capital markets still have a ways to go. There are a lot of beneficiaries from fewer players. Like Goldman Sachs would say 70% of their competition has pulled in their horns or gone away. So they're benefiting, but I don't think there's any time to be bullish about the capital markets on a broad basis because they're still so expense-ridden. I mean, these companies are still so missized. They've got to lay a lot of people off to actually be profitable.
As far as the loan losses, a couple of appearances ago, you said that you are expecting credit lines to be cut for consumers. We've seen what has gone on in terms of loan losses on an institutional level, corporate level. What about consumer? Where are we in that, credit lines being zapped on the part of consumers?
Well, $500 billion of credit lines were cut in the fourth quarter alone. There are a couple reasons why companies are cutting credit lines. Number one, and this is probably the smallest reason, is because you've got to put regulatory capital against your exposed lines. Number two, and this is probably the biggest reason, is just risk aversion. So an example like Citi has $1 trillion of unused lines or total commitments outstanding and $200 billion of used lines. Why would they have $800 billion in unused lines? That's just so much risk because when the consumer gets under duress, they don't charge off at $200 of a $1,000 credit line. They max out and then they charge off. So it's too much risk exposure to any given lender. So you've already seen an acceleration. Credit lines or cuts to credit card lines way beyond my expectations in terms of how fast it occurred. And I think you see ultimately 55% of all credit card lines cut out of the system. That's going to have a really underappreciated impact on total U.S. commerce and global commerce. And then that affects, obviously, jobs, because 2/3 of the economy is supported by the consumer, jobs, corporate spending. It's sort of a vicious cycle here.
Yeah, and it certainly is going to impact the broader economy and probably lead to what most people are expecting to be higher unemployment. Okay, so to recap, in terms of the banks, we got sell-offs again on the financials today. You want to say
mild sell-offs,
but you want to say, look, lay off on the shorts. Don't buy into this sell-off here because we are going to see some positives when the group reports.
Yeah, and then put them out again because the fundamentals aren't getting any better, but the capital ratios are sure to get better. There's no doubt about that. The government has eased rules, has actually put capital into these banks through what I would call backdoor financing through these agency trades. Remember when in the fourth quarter when the Fed said they were buying agency paper, the big banks, the top 10 banks, increased their buying of agency paper or their holdings of agency paper by 30%. I haven't seen that in my career as an analyst. So effectively put on a big carry trade, and it worked out well for them. So that's a way to fuel billions of dollars in the back door of these banks.
Great insights. Meredith, always great to have you on the program.
Thanks, Maria.
Thank you so much. Meredith Whitney is founder, CEO, Meredith Whitney Advisory.